Welcome to The Deep Dive. We're the show that, cuts through the noise, digs into the sources, and pulls out the key knowledge to get you up to speed, fast. Today, we're taking a really deep plunge into something foundational in finance: packaged investment products. Specifically, mutual funds. You probably encounter them, maybe more than you think, like in your retirement plan, brokerage account, that kind of thing. But even though they're super common, how they actually work sometimes feels a bit opaque, a black box. So, our mission today: demystify these things, give you a real shortcut to understanding this pretty essential financial tool.
And, a lot of that structure, the clarity, and especially the investor protections we count on, it really comes down to a key piece of legislation. That's the Investment Company Act of 1940. It's basically the rule book, the backbone for how these products are set up and how they have to operate.
Right. That's a really crucial piece. So I'm excited to unpack the real benefits they offer, how they function behind the curtain, and just the sheer variety that's out there. By the end of this, you should have some practical, actionable knowledge, stuff you can actually use. Okay, so let's really unpack this. At its core, what is an investment company? It's actually a pretty straightforward idea. It's basically a way for lots of different investors to pool their money together. This big pool of cash is then used to buy a whole portfolio of securities, stocks, bonds, whatever, and it's all done for the benefit of those investors who chipped in. Think of it like collective investing power.
Exactly. And that 1940 Act, it actually laid out a few different types. There are things called face amount certificate companies, unit investment trusts or UITs, and then there are management companies. Now, these split into open-end and closed-end funds. For today, though, we're really zeroing in on the open-end ones. Those are what pretty much everyone just calls mutual funds. They're definitely the most common, the most widely used type out there.
Okay, so the basic concept is investors, maybe with similar goals like, say, long-term growth or maybe income, they pool their money. Then there's a board of directors elected by these investors, and that board hires a professional, an investment advisor, to actually manage the portfolio. Pick the stocks, make the trades. All right, now here's where it gets, I think, really interesting for most people listening: the actual advantages. Why use a mutual fund? And these aren't just small things, right? They're pretty fundamental reasons why they're so popular.
Oh, absolutely. The first big one, maybe the biggest, is diversification. You know that old saying, don't put all your eggs in one basket? That's exactly what mutual funds do. They spread your money across maybe hundreds, sometimes thousands of different investments, different stocks, different bonds. So that really helps lower your overall risk. If one company tanks or even one whole sector has a bad run, it doesn't completely wipe out your investment.
Right, it cushions the blow.
Precisely. And what's fascinating here is when a fund calls itself diversified, it's not just like a casual term. There are actual rules from the regulators. To meet the standard, at least 75% of the fund's assets have to be diversified in a specific way, meaning generally no more than 5% of its assets can be in any one company's securities, and it can't own more than 10% of any one company's voting stock.
Ah, okay. So there are real guardrails.
Yes, exactly. That 75% test has to be met when they initially invest that portion of the assets. Now, there are also non-diversified funds, maybe focusing on one industry. They have potentially higher rewards, but definitely higher risk because they're concentrated.
Okay, that makes sense. What else?
Another huge benefit, professional management.
Mm-hmm.
Let's be honest, most of us don't have the time or maybe the deep financial knowledge or even the tools to constantly research companies and manage a big, diverse portfolio ourselves. And hiring your own personal money manager, that can be really expensive.
Yeah, out of reach for most people.
Right. So mutual funds give you access to these professional managers. These firms, they have to be registered under the Investment Advisors Act of 1940, by the way, and you get their expertise for, a fraction of what it would cost to hire them directly. It's like having a whole team analyzing the market for you. Just a quick distinction. The investment advisor is the company hired by the fund, and the investment advisor representatives are the people working for that company.
Got it. Professional management at a lower cost. What's next?
Liquidity. This is just how easily you can sell something and get your cash back at a fair price. Mutual funds are considered very liquid, but here's a key difference from stocks. You don't sell your shares to another investor on an exchange during the day. Instead, the fund company itself issues the shares when you buy, and it buys them back, redeems them when you sell.
So there's always a buyer, essentially, the fund itself.
Exactly. You can pretty much always sell your shares back to the fund on any business day.
Okay, that's good to know.
And then there are exchange privileges. This is pretty handy. Lots of big fund companies offer a whole family of different funds, growth funds, bond funds, international funds, all under the same brand name. Often, they let you switch your money between funds within that same family, usually at net asset value, meaning without paying another sales charge.
Oh, that's convenient if your goals change or the market shifts.
Yeah, it makes adjusting your strategy much easier.
Okay, and what about the practical side, just managing it all?
Right, the convenience in record keeping. This is a big plus, too. You can usually set up automatic investments, like pulling money from your bank account each month. Very good for disciplined investing. You can also have dividends and capital gains automatically reinvested, buying more shares for you. Helps with compounding. And, the fund company does all the heavy lifting on tracking everything. They keep records of your purchases, your sales. They send you year-end tax summaries. That's Form 1099 DIV usually. And you get detailed reports, semi-annually and annually, showing performance, holdings, expenses.
So what this really means for you, the investor, is it just simplifies things. Less paperwork, easier tracking.
Definitely. It streamlines the whole process.
All right, that covers the why. So now that we get the appeal, let's pull back the curtain a bit more. How are these things actually structured? What are the rules? Who are the key players making it all work?
Okay, so back to that Investment Company Act of 1940. It's central here. It mandates that any investment company wanting to sell shares to the public needs to register with the SEC, the Securities and Exchange Commission. And there are a couple of initial hurdles. Generally, they need to have more than 100 shareholders already lined up, and they need a minimum net worth of $100,000 before they can make that public offering.
Okay, so there's an entry barrier. And for us, the investors, what's the key document?
Without a doubt, it's the prospectus. This isn't just like a sales brochure. It's the official, legally required disclosure document. It's packed with crucial information. Things like the fund's specific investment goals, its strategies and policies, the main risks you're taking on, its past performance history. Also, who the managers are, what the operating expenses and any sales charges are, the different types of shares available like Class A, Class C, etc. And importantly, how they calculate the share price, the net asset value or NAV, plus exactly how you buy and sell shares and those exchange privileges we mentioned.
So this raises a key question. Why is this document so vital? Why can't you skip it?
Because it's essentially your owner's manual for the investment. It lays out exactly what you're getting into, the good, the bad, the risks, the costs. Reading it helps you make an informed decision, not just jump in blind.
And there are rules about getting it right.
Yes, very strict rules. It's called the prospectus delivery requirement. Any offer to sell you mutual fund shares must be preceded by or accompanied by the current updated prospectus. Doesn't matter if it's a physical copy or electronic, you have to get it. And brokers, registered reps, they are absolutely forbidden from marking it up, highlighting stuff, or changing it in any way. You get the official document, period. Full disclosure.
Good to know. Okay, maybe quickly clarify some terms we hear thrown around.
Sure. A sales charge is often called a sales load. Same thing. The net asset value, or NAV, that's the underlying value per share. It's sometimes called the bid price or the redemption price, because that's what you get when you sell back to the fund. And the price you pay when you buy, if there's a sales charge, in the public offering price, or POP. Was simply the NAV plus that sales charge. POP equals NAV plus load.
Okay. NAV is the base price. POP is what you might pay to buy.
Yeah.
Got it. Is there anything beyond the prospectus?
Yes. There's something called the Statement of Additional Information, or SAI. Think of it as the prospectus's more detailed sibling. It dives deeper into the fund's policies, risks, and operations. It's not required to be given to you automatically like the prospectus, but the fund has to provide it if you ask for it. It's there for folks who want even more granular detail.
Okay, so a lot of rules, a lot of required info. Who's actually, running the show behind the scenes day to day?
Right. It's not just one entity. It's really a team effort, a structure designed for oversight and getting the job done. First up, you have the board of directors. They're elected by the shareholders, the people who own the fund. Their main job, protect the shareholders' interest. They set the overall investment policy for the fund, though big fundamental changes usually need shareholder approval too. They also decide when to pay out dividends or capital gains, and critically, they hire and oversee the key service providers, like the investment advisor.
Okay, so they're the oversight committee, basically.
Sort of, yeah. Then you have the investment advisor. This is the company, the professionals we talked about earlier, that actively manages the fund's portfolio. They do the research, analyze markets and economic trends, decide which specific securities to buy or sell, all according to the fund's stated objectives and policies set by the board. And importantly, they get paid a management fee. This fee is typically calculated as a percentage of the fund's total assets under management, the AUM, not based on how well the fund performs.
That's an interesting point. Their pay is tied to the size of the fund, not the performance.
Generally, yes, it's based on assets managed.
Okay. Who else is involved?
You need someone to hold the actual assets safely. That's the custodian bank. The 1940 Act requires funds to use a qualified bank as custodian. Their job is to physically safeguard the fund's cash and all the securities it owns. They also handle payments coming in and going out. It's a crucial role for preventing theft or loss. But, and this is important, the custodian doesn't guarantee the value of the investments. They just protect the assets themselves.
Right, they don't protect you from market losses, just from the assets disappearing.
Exactly. Then there's the transfer agent. They're the official record keepers for all the shareholders. When you buy shares, they issue them. When you sell, they cancel them. They handle distributing the dividends and capital gains payments to you, and they're usually the ones sending out your account statements, tax forms, and those annual reports.
So all the shareholder admin stuff.
Pretty much. And finally, you have the principal underwriter. This entity might also be called the sponsor, wholesaler, or distributor. Their main function is selling the fund's shares to the public. They might sell directly to investors, or more commonly, they sell through intermediary dealers, like brokerage firms you might have an account with. And there are FINRA rules about how they price the shares consistently when selling through different channels.
Wow. Okay, so if we connect this to the bigger picture, this whole structure, the board, advisor, custodian, transfer agent, underwriter, it's all designed with checks and balances.
Absolutely. It's built for oversight, specialization of duties, and ultimately investor protection.
Okay, that makes a lot of sense. So we know why people use them, how they're structured, but there are just so many mutual funds out there. How do you even start to choose?
That's the million-dollar question, isn't it? The key is that funds are usually grouped or categorized based on their primary investment objective. What are they trying to achieve? That's your starting point for finding a fit.
So can you give us a quick flyover of the main categories?
Sure, let's group them a bit. First, think about funds focused mainly on growth. You've got aggressive growth funds. These guys swing for the fences. They often invest in smaller companies, maybe ones that are growing really fast, sometimes even IPOs, initial public offerings. The goal is maximum capital appreciation. Historically, potential for high returns, but definitely comes with higher volatility and risk. Then, just plain growth funds. Still focused on capital appreciation, but maybe investing in slightly larger companies that are still expected to grow faster than the average. Less extreme than aggressive growth, usually.
Okay, growth seekers. What else?
Then you have funds with a more specific focus, specialized or sector funds. These concentrate on just one industry like tech or healthcare or energy or maybe one specific geographic area, can offer unique opportunities if that sector does well, but way more risk because you're not diversified across the whole economy.
Right, putting more eggs in one basket, basically.
Kind of, yeah. International and global funds. Quick distinction. International funds invest outside the U.S. Global funds invest everywhere, including the U.S., so for exposure beyond domestic markets.
Got it. International is ex-US, global is worldwide.
Correct. Now, what if you're looking more for income, or maybe a mix? Equity income funds. These usually buy stocks of large established companies known for paying regular, often high, dividends. The main goal is current income, usually with less focus on big price growth, often seen as more stable. Growth and income funds. Trying to get a bit of both worlds. They look for stocks that might appreciate in value and pay decent dividends. A balance. Bond funds. Pretty straightforward, they invest in bonds. Main goals are usually current income from the bond interest payments and preserving your initial investment. But remember, bonds aren't risk-free. They have interest rate risk, credit risk.
Right, bond prices can go down too.
Absolutely. Okay, then there are funds driven more by a specific strategy, index funds. These have become hugely popular. They don't try to beat the market. They just try to match a specific market index, like the S&P 500. Because they just buy what's in the index, that's called passive management, their management fees are typically much lower. You aim to get returns very similar to the index itself.
Low-cost market matching returns.
Yep. Value funds. These look for stocks that the managers think are on sale, maybe companies that are out of favor with investors or seem undervalued compared to their fundamentals. Often takes patience, more of a long-term play, hoping for a turnaround. Balance funds. These maintain a pretty fixed mix of assets, maybe like 60% stocks, 40% bonds, and cash, for example. Provides built-in diversification across asset classes, asset allocation funds, similar to balance funds, but the manager has more flexibility to change the mix, more stocks, less bonds, etc., based on their view of the market outlook, more active shifting. And finally, money market funds. These invest in very short-term, high-quality debt like treasury bills or commercial paper. They aim for safety and liquidity above all else. NAV is usually kept stable at $1 per share. Good place for cash you need soon or want to keep very safe.
Wow, okay. That really is a huge range, from super aggressive growth to ultra-safe money markets. It covers pretty much the whole spectrum. So thinking about that incredible variety, what stands out to you about these different approaches, and maybe how should someone listening start thinking about where they might fit in?
That's a great question. What really stands out is how tailored they can be. There's likely a fund category out there designed to meet almost any reasonable financial goal and risk tolerance. The key insight for someone listening isn't to memorize every single category. It's to first get really clear on your own situation. What's your main goal? Growth, income, stability. What's your time horizon? How comfortable are you with risk, with seeing your investment value fluctuate? Answering those personal questions first acts like a filter. It immediately helps narrow down that huge list of the categories that actually make sense for you. Don't start with the funds. Start with yourself.
Excellent advice. Start with your own goals and risk tolerance. Okay, let's get down to brass tacks then, the practical side. How do you actually buy and sell these shares? And let's talk about those fees, the sales charges people often hear about.
Right. So when you buy mutual fund shares, you purchase them at the public offering price, the POP. When you sell or redeem your shares, you get the net asset value, the NAV. If there's a sales charge or load involved, it's the difference between those two. So the basic formula is POP plus sales charge. If there's no sales charge, then POP simply equals NAV.
And how is that NAV calculated again?
The NAV is the fund's per share value. They calculate it by taking the total market value of all the securities the fund owns, plus any cash, then subtracting any liabilities the fund has, like expenses owed. That gives you the total net assets. Then you just divide that total by the number of shares currently outstanding among all investors. And this calculation has to be done at least once every business day, typically right after the major U.S. stock exchanges close, which is 4 p.m. Eastern Time.
Okay, calculated daily. Now, you mentioned something earlier about pricing being different from stocks.
Yes, and this is absolutely crucial to understand. It's called end-of-day pricing, or more formally, forward pricing. Here's where it gets really interesting and fundamentally different from buying, say, Apple stock. When you place an order to buy or sell a mutual fund, you don't get the price that exists right at that moment. Instead, your order will be executed at the next NAV calculated after your order is received by the fund company or its agent.
Can you give an example?
Sure. Let's say you put in an order to buy shares at 11 a.m. on Tuesday. The market is open, but you won't know your purchase price yet. Your transaction will be priced using Tuesday's NAV, which won't be calculated until after 4 p.m. that day. Now, what if you place your order later, say at 4:10 p.m. Tuesday, after the market is closed?
Then you get Wednesday's price.
Exactly. Your order won't be processed until the next business day is closed, so you'd get the NAV calculated at the end of the day on Wednesday. It's always the next computed price.
That's a huge difference from seeing a stock price update second by second.
It is. No intraday trading for mutual funds based on live prices. It ensures fairness, so nobody can jump in late based on after-hours news. Everyone gets the same closing price for that day.
Okay, forward pricing. Got it. And how quickly do trades settle?
Mutual fund transactions are usually pretty quick. They typically settle on the same business day, T+0, or the next business day, T+1, after the trade date, meaning the cash moves and ownership changes hands fast, much faster than stocks used to be.
All right, now, the fees, the sales charges. Let's break those down.
Okay. The most traditional type is the front-end load. You often see this with Class A shares. You pay the sales charge right up front when you buy the shares. It's deducted from your investment amount. So if you invest $10,000 and there's a 5% front-end load, $500 goes to the load and $9,500 actually buys shares. The FINRA, the regulatory body, actually caps the maximum front-end load at 8.5% of the POP. But frankly, you rarely see them that high anymore, usually much lower. And importantly, most funds with front-end loads offer breakpoints. These are reduced sales charge percentages for larger investment amounts. The more you invest, the lower the percentage charge typically gets.
So there's an incentive for larger investments. How do you figure out the percentage?
The formula is POP minus NAV divided by POP, not divided by NAV. So if a fund's NAV is $17.25 and its POP is $18.40, the sales charge is $1.15. You divide that $1.15 by the POP of $18.40, which comes out to about 6.25.
POP, NAV, POP.
Got it.
What's another term?
Then you have back-end loads, also called contingent deferred sales charges or CDSCs. You often see these with Class B or sometimes Class C shares. With these, you buy shares at the NAV, so your full investment goes to work immediately. The sales charge is only assessed if you sell your shares, and typically only if you sell within a certain number of years. The percentage charge usually declines the longer you hold the shares. For example, it might be 5% if you sell in the first year, 4% in the second, and so on, until eventually, maybe after 6 or 7 years, it disappears completely.
Ah, so it rewards long-term investors.
Exactly. If you hold the shares long enough, you might end up paying no sales charge at all. And regulations require that if you buy shares with the CDSC, you get a clear written disclosure explaining exactly how it works and the schedule of charges.
Okay, front end paid upfront, back end paid potentially at sale. What else?
The third main category is no-load funds. These are pretty simple. They sell their shares at the net asset value. So the NAV equals the POP. There's no sales charge added on either upfront or at the back end. You often buy these directly from the fund company or through certain brokerage platforms that don't add their own fees. Now, there's a strict definition here. For a fund to truly call itself no-load, it can't have a front-end load, can't have a deferred sales load, CDSC, and critically, it can't charge certain ongoing marketing or distribution fees, known as 12b-1 fees, that exceed 2.25%, a quarter of 1% of its average annual net assets.
So no load means genuinely minimal sales-related charges.
That's the idea, yes.
Yeah.
Though they still have regular operating expenses, like the management fee we discussed earlier, no load refers specifically to the sales commission part.
Right. So thinking about all these different ways fees can be structured, what does this really mean for your bottom line, for your actual investment returns over time?
It means everything. These costs directly reduce your net return. A higher fee, whether paid up front, over time, or at the end, means less of your money is actually working for you and compounding. Understanding the fee structure, not just the percentage, but how and when it's charged, is absolutely critical when comparing funds. It can make a significant difference in your wealth accumulation over the long run. You really have to factor it in.
That's a perfect summary of why this stuff matters. And just like that, wow, we've covered a ton of ground on mutual funds. We started with the basics, what they are, then dove into the big advantages like diversification, professional management. We looked under the hood at the structure, the regulations, the key players, explored that huge range of fund categories, and then got practical with how buying, selling, and pricing works, especially those fees. Our goal, as always, was to give you that comprehensive, but hopefully pretty digestible deep dive to deliver some genuine insights you can take away.
Yeah, and if we connect all this back to the bigger picture, the real takeaway here is empowerment. Understanding this stuff, how funds work, the terminology, the costs, it means you can navigate the investment world with way more confidence. You can ask smarter questions, whether you're talking to an advisor, looking at your 401k options, or just doing your own research. It shifts you from being maybe a passive recipient to an active, informed participant in your own financial future.
Couldn't agree more. It really does change the game when you feel you understand the mechanics. So, here's a thought to leave you with. Knowing all this now, what might you explore next? How does understanding these nuts and bolts maybe shift your perspective on how you choose investments, or even just the questions you might ask now about the ones you already own? Something to definitely mull over. And on our next deep dive, we're going to continue this exploration of packaged investments. We'll be touching specifically on closed-end funds and unit investment trusts, or UITs, those other types we briefly mentioned earlier. Thanks so much for joining us for this deep dive.